also shared you my screen. So if you can see this small welcome icon, the picture, you can just say yes, or just use the chat button to indicate to me that you have been able to see. Yeah, fantastic. Thank you, Harris. Thank you, Bogdan, for confirming. So I'm sure you all know this, but within this Blackboard Collaborate, there is a tool that can allow you to chat. That's the icon here, which so many of you have already used already today in this session. And you can also see, as I'm sharing you the screen, it is 30 students, and myself included, one is joining, so 31 attendees in total. Okay. All right. So I believe most of you also saw me this morning when you joined Banking Risk 1. That was delivered by Jerry. So I don't need to give you a long introduction, but for those who just joined now and were not there in the morning, this is me. Okay, and as I requested in the past, just call me using my first name, which is Benham. And you can email me just by clicking here, or you may have already seen my email address somewhere within the Blackboard site, but it's always easy. Why not I just type in my email address here. Okay, that's my email address, and that's something I'm going to send to everyone now. Okay, so you know my name, you've got my email address. Nothing should stop you talking to me, communicating me, emailing me, whatever way you prefer to talk to me, communicate me. Okay. Now, I was telling this to all my students whom I was teaching online, that I'm so thankful that I will be meeting my students pretty soon face to face. And you know, we, the tutors, really have missed the opportunity to be face to face with the students, the school environment, the building, the cafeteria, and so on. So really grateful that I will be meeting you soon. Okay, this week I've got a session workshop to some of you. I think it's on Friday at 9 a.m. So those of you who are in my time slot, I will be seeing you there. Okay, so now that we've got sizable number of students, I think it is best that we now proceed. Okay, it's 5 past as well. So what I will do, I will just take note of your names, and I will see later on how I can record your attendance. So all those students who is here, whose name I have copied just now, you will be marked as attended. Okay, I've got your name here. This is something I will work out later on after I finish teaching you all nice students. Okay, and thank you very much for arriving in time today for the lesson. Okay, all right. If I have missed someone because you joined late, just let me know and I will put your name there as well. Okay, but all those of you who were here about 5 past, I have already noted your name in my file. Okay, superb. I really wanted to ask you, how are you all? Okay, because it's the first day and I just don't want to jump into the lessons. I wanted to get that feeling that I am, with my students. I know the computer environment doesn't give that ambience, but if you want to say something, let me know. I hope you all had some nice time over the summer. Um, I had booked some holidays, but we had COVID in the house, so we had to cancel it. But we did go some other nearby places, and it was not bad. Um, so that's in my case, and I can also tell you that I live in Newcastle. I'm not very far away from our school building. It takes me around 15-20 minutes, 15 minutes drive, and I can be in the school, and that's what I'm looking forward to do tomorrow and the rest of the week. Okay, but Anna, don't worry, I had seen you in and out, so I will just take a note of your name here. Thank you for informing me. Okay, so Anna K. K-I-S-L, something was there. K-I-S, oh, Kiselva. K-I, that one, yeah. Okay, so just in case I've missed out some other students, you can always tell me. From next time onwards, we'll make like a small rule of engagement related to attendance, which is if you are in the room within the first 5 minutes, I will definitely put your name down as attended. Okay, after that, you really need to tell me, and then I'll put your name down as well, but try to be in time. Okay, okay. It's just not to miss the lesson and the opportunity to engage with me. So I'm going to take you to the module Blackboard site, and this is the module Blackboard site, which I believe you already have access to. If you have encountered any problem logging in to the Blackboard, just let us know, or you can also write to Saba, who is your deputy program leader. Okay, I can also write Saba's email address for you. That's something I will do right now. It's just s dot, I know that email address. Okay, s.shamadv at. Okay, that's Saba's email address. You've got mine as well. You can always ask questions to us. Because this module will be taught to you by two of us, myself and Saba. Okay, Saba will be taking some of the workshops. You can also call it seminars. All the workshops are to be held in our fantastic Bloomberg lab, which is room 025 on the ground floor of City Campus East building. If you don't know where it is because you're new, just let us know, and we can help to navigate. Okay, but any question, any concerns, any help you need on the academic matters, please feel free to write to me or Saba. And I just told you Saba is also your deputy program leader, Julie being the main program leader. Okay, but the module itself will be taught to you by myself and Saba. Josh has a good question. How can I get access to the timetable? All right. I will ask Saba to send you an email regarding that. You should get a link, and after pressing that link, you should be able to see your timetable. That's exactly what I do. So the same link can be forwarded to you. If there's anything otherwise, Saba will definitely speak to you. I have requested Saba to join today. and I know he's teaching now, just to welcome you all. I know majority of you have already been taught by Saba last year when he was teaching you derivatives. So I know most of you already know him, but I am also aware that there are a few students who are new, who may be joining as top-up students. So it would be nice for you to see both of us today online and in the days to come on the campus. Okay, you're welcome, Josh. Now, there are so many things that we want to talk. And I can also assure you that in terms of materials, content, delivery in this module, there is so much that you will feel like, oh, I've got so much materials. And these materials are going to be useful to you even after you finish your studies. And I do not want my students not to take those materials with them after graduation. So I would also encourage the students to be, saving what we are using to teach you guys, including the workshop questions, answers, and so on. And alumni, my students whom I have taught in the past, who are working in different asset management companies, banks, they do tell me that the materials have remained useful to them even after completion of their studies. So that reminds me to tell you that shape these materials somewhere in the cloud so that you can find them. Okay. Well, I will be talking about these, tips, suggestions every now and then. But today we now need to start. And as I told you, this is the module side. What I will do, I will just click student preview so that what I can see and share from the screen is exactly what you will see from your side as well when you will log in to the module Blackboard side. So as of now, you can only see week 1 material. And if you click that, you will see the lecture slide and a small workshop question. Okay. And there are 2 journal articles here, and both the journal articles are motivated to, in a way, inspire you to think in terms of economic activities, generally in relation to, forecasting. How does what is the market outlook in terms of what the economic indicators tells? So these articles are really good in terms of the use of economic indicators, so you can read them in your own free time. The workshop question for this week, as you will see, is really straightforward and easy, but we will be doing so many other things in the workshop, and you'll find it really engaging. Okay. Today, this is the lecture slide, so I'll be using the lecture slide to talk, but I may not be, using each slide when I'm providing you my delivery. In some slides, I may be spending more time than some others, whereas in case of some slides, I may be moving faster. But, this is just the process of engagement. So, and if you've got anything to ask at any point in time, you can use the tools. You can also use your microphone and talk to me. It is always nice to hear you, and that's something I would encourage. But if your microphone has some trouble, or you feel more comfortable to use the chat, then do that. Okay. So we are now going to proceed with the lecture. It's 15 past now. First day, first week, first day in my module. So here we go. Okay. So it is basically the introduction to investment. You can also call introduction to the module. But what we'll be discussing today can be very helpful to your assignment question number 1. Of course, you'll be learning a lot more than this week's topic in order to help you answer that assignment question number 1. But some of the discussions that we'll be making today are directly relevant to what you would need to do and complete in relation to assignment question number 1. So this is going to be useful. Okay. Now, I know that I have not discussed about the assignment task yet. I just don't feel like talking about the assignment in day 1. Okay, so we will leave it for few days. Okay, maybe next week I will talk about it. I don't want you to feel that there is so much to be done, but in reality, this is one of the modules wherein you are progressing your assignment as we progress our weekly teaching. Okay, so what you'll be doing on a weekly basis, a daily basis in terms of your learning, you can translate them into your assignment. From week 3 onward, you'll also be using Bloomberg heavily, and what you will be doing in the Bloomberg is very important for the assignment purpose. Okay, so therefore, in a way, this module is experiential. You learn something there, you experience something, you translate them into your assignment. A lot of these will be discussed, explained, and we'll be there. Okay, we'll be there always to help you. I can also mention to you that similar to previous year, we will also have a drop-in session every week, and this drop-in session is going to be kindly facilitated by Saba. And the timing of this drop-in session will be every Monday after 12 p.m. because we will be there in Bloomberg room after midday. And after midday on a Monday basis, the Bloomberg room has been found empty. Okay, there's no timetable class taking place in that Bloomberg room after 12 p.m. every Monday. Okay, and I'm hoping that it will remain the case for the remainder of the year, which then basically means it makes sense for us that we are there. Definitely Saba will be there every Monday from 12 p.m. onwards, and you can call it a drop-in for you. You can just bring your question there, talk to us, and we'll see how best we can help you. Okay. So as I said, there will be a lot in terms of engagement from our side, and that's how we want to help you, and help you in a way to help us as well, because we really want you to enjoy. When you enjoy, we feel good as well. Okay, so now I think I have opened my lecture slide, and the objectives of these lectures are as follows. Okay, so basically it seems really simple. First day, introduction to investment. Why should I make it difficult? Topics to be covered are therefore investment basics, investment preferences, investment management process, and market view judgment. Okay, let me tell you, the market view judgment, the last topic here, is basically related to the forecast related to the economy. So what do you think is going to be the case for the market where you made your major investment? If it is UK, do you think the market will remain bullish? Will it be bearish? You know, that kind of analysis is what you want to cover in the market view judgment. Other topics are simple, but we'll go through them one by one, and you will see that they should make some meaningful answers to various questions that you may have. Definitely in relation to question number 1 of your assignment task, these topics are going to be helpful. Okay, just wanted to check if you all are hearing me. Are you all fine? Yes, excellent. You know what happened last semester when I was teaching, was talking 25 minutes on my own. and the students were not there. So after that point, I've decided to check. It was just some problem with the server in the university, and the Blackboard Collaborate was not working. Okay, so it's important that I am checking with my students that they are listening, which I can see Bogdan and Galibe has confirmed. So thank you very much. Just in case I pronounce your name incorrect, talk to me and tell me. Okay, okay, superb. Now, so what is investment? Let's start with this definition. Okay, investment basically is setting aside your fund with an expectation that the fund will grow over time. Okay, so you keep some money aside, and there is an expectation that that money will grow. Now, there are three key elements to this. One, time, which basically means after you set aside some money, separate some money, you need to wait. Therefore, we also say return is the compensation against waiting. Yeah. And then that expectation of return is there. Okay. So time, you need to wait. Return is what you expect. And there is also an element of risk. Okay, so you can think similar to what you are able to see in this diagram. If the weather is really adverse, and some other variables can impose a risk to the growth of your plant. Okay, something similar in the case of investment as well. Although you may be waiting for a time period, you may not get the return that you expected because there is a risk. Okay, but just in terms of layman language of defining investment, it is simply setting money aside with an expectation that the money will grow over time. Three key elements: time, return, risk. That's it. Now, just wanted to share some thoughts about what do you think about making use of that definition that I just talked about and relating it with buying the lotteries. Okay, so I just want you to share me your thoughts and tell me if you think buying a lottery is investment or not. Okay, because yeah, Bogdan, do you want to say something? That's wonderful.
Yeah, I thought that's like a question, isn't it?
Yeah, sure.
So yeah, I suppose it's not an investment as the chance of getting some return is like lower than being hit by lightning. So yeah.
Excellent, excellent. Thank you. Thank you for your engagement, Bogdan. So Bogdan just said that the chance of winning the lottery is very, very slim. Hence the reason why it is not an investment. But if you just relate with my definition of investment, you may then think, I bought the tickets, lottery tickets, a week ago, and the following Saturday is the announcement of the winning numbers. So I've waited for that time. Of course, there's a risk because there are plenty of people playing and only one is going to be the winner. But if there's a chance that I may win. So if you just see in terms of the definition and the components that are described in terms of the definition of investment, you may think that yes, lottery is an investment, but like Bogdan just said, this is not investment in pure sense, and we do not deal with such investment in this module. Okay, and I'll give you some mathematical reasons as well, but similar analogy can also be applied to some other, such as this, playing casinos. That's not what we cover in this module. That's not the investment in the pure sense of making money through setting aside the fund in financial security, so we do not include them. Okay, now you may then say, what about betting in a horse race? Because you may have spent time researching about the race, researching about a particular horse, yeah, jockey, everything, and you have come to this conclusion that compared to those 12 horses taking part in that competition, I know very well this is going to be a clear winner. I invested the money a week ago. The horse racing is taking place after 5 days or so. I've waited that long, and so on. Again, of course, this sounds, when you put everything together, this sounds a little bit better in terms of, you know, the analysis and research that one may have made. But again, this is not included within the scope of investment in this module. So we do not include casinos, we do not include bettings, we do not include lotteries. Do not talk about them. Today is the first and the final day that I'm speaking about them. Okay. Now, can I tell you something that in this model we want to include the quantitative aspect. So every now and then you'll be saying, oh, Shava is using Microsoft Excel all the time to explain something, and Binam also aims to do something similar. Okay, it's mainly because we want our students to be numerically sound, and that's a key aspect. And employers in the field of, you know, investment management, they seek the fact that the candidate have good awareness of these quantitative or numerical skills. So very quickly, I will just mention why the chance of winning the lottery is so slim. Okay, so this is just an example, and in a way, first day I want to encourage your thinking in terms of those quantitative skills. So I'm just going to make use of the normal lotto. So those of you who have played already this type of games in the UK, you are aware about the games, but let's make it simple. Okay, so you're allowed to select 6 numbers from the 49. So I'm just writing it here, and then I will explain everything. Okay, so in a 49 chooses 6. Okay, or you can say select the 6 from 49. Okay, so I've given you the scenario. If you're playing the national lottery, and the national lottery, if it is the case that when you have 6 numbers exactly matching to those winning numbers, then you will be the clear winner. Okay, so that's the scenario which those of you who have already played or were aware about the national lottery, you would know this. Now we just wanted to quickly make quickly find the evidence that winning the national lottery, you know, the chances are very slim. So I just want to ask you this question quickly. What do you think is the order of winning the lottery? What is it? Do you know? Do you want to say something in terms of, you know, what is the chance of winning the lottery? You may have heard about it. Less than 1%. Okay, Bogdan, that's a good guess. Anyone else? And I just also wanted to ask you a second question, which is, you know what? All right, James, that's really good. Yeah, really good. Of course, it also depends on the type of games. The scenario that I have presented you here it's 1 in 13 million. Okay, but that means it's very slim. But I just want you to, you know, involve in those computation aspects, so that you feel and you get the feel that this module will have some good amount of numerical aspects. Okay, but thanks for that engagement, Bogdan and James. 1 in 50 million is also a very good guess. I've already given you the answer in a way, but at the same time, I wanted to encourage you to think what you did in your school long time ago in terms of combination and permutations. You may have learned about them. Yeah. So let us first think in terms of the probability theory. Okay, so if you just apply the probability theory, then you will say, okay, if the sixth number is a match, then the probability would be something like this. And so the first number is already gone, so now I've got 5 remaining, and the probability here will therefore be 5 divided by this. Okay, and so on, so that you get these numbers. Okay, now you may remember from what you studied in your statistics a long time ago, when you need to combine them, you say the sixth has matched, and fifth has matched, and fourth has matched, and third, and second, and first. So when you're using and, you basically multiply, isn't it? So multiplying in Excel is easy if you use the function product. So that's it. That's the answer. This is the answer. Okay. But you may not feel that great about it. That what is this answer? This answer is saying, you know, those 7 zeros first, and then 7.15. Okay. And but I said to you, the answer is 1 in 13 million. Okay. And if you want to look into that in a different way, then you can do this as well. Okay, so it basically means instead of 6 over 49, what I have done here is 49 divided by 6. Okay, and this is another way. And something else that you have learned in the past is when you do not need the winning numbers in order. Okay, when you do not need the winning numbers in order, then you can simply apply permutations. You do not need to apply combinations. Okay, so when you apply permutations, then the formula would be n factorial divided by r factorial times n minus r factorial. Okay, I'm just trying you to think what you did in the past. Another reason is just to give you that flavor of what we need to do. Okay, so I mean mathematical inclusion. So 49, and then r factorial is 6. Okay, and n minus r will be basically 49 minus 6. That will give you 43. Okay, so what we are saying here, the number total 49, that's n, and you are from 49 you're allowed to choose the 6. Yeah, so select 6 from 49, or 49 is going to select 6. So that's what we say in the language of permutation. N takes r. Okay, 49 takes 6. To be really simple, n takes r. Now in terms of factorial, what is it? You may already know it's here. If you were to find the factorials, it would be 6. Then in descending order, you'll be multiplying 5, multiplying 4, multiplying 3, multiplying 2, multiplying 1. So that's what it gives you, 720. But what you can do is just ask the computer to do it, and it will give you the same number quickly. Now I'm going to save my time because I don't want to waste time writing all these numbers there. Hence the reason why I will just put it here. Okay, copy it, paste it here. Copy it, paste it here, and then 49 factorial I have already received. 43 factorial is also something that I have received. So next thing is simply 49 factorial divided by r factorial, which is this number here, 720, times the 43 factorial, because that's 49 minus 6, which is this number here, and that's what we will receive as the answer. Okay, so these many combinations can be the case if you're in terms of order of winning the lottery. So that's what I was saying to you, 13 million, 1 in 13 million. Now, if you just do equal 1 divided by this, and what you received before in terms of the probability in decimal, those long decimal, you should receive the same. Okay, so that's what you receive if you were to expand this. Okay, so that's exactly the same answer as here. Okay, yeah, so I can just expand. All right, so we've done it. Sorry, so I've shown you in terms of probability, and probability is very important, and this is something I'll be discussing, although briefly, in the days to come, why the traditional investors, the investors should be following the logic of probability in investment. Okay, whereas people who believe in behavioral finance, they may not follow the probability theory. Okay, so that's something I'll be talking in the days to come. But just to be brief, I've shown you 2 ways of finding the odds of winning the lottery. If you think this number is too small and therefore it doesn't give you a good feeling, then you can just see this 13 million here computed using the factorial thing. At the same time, I also mentioned to you that you can also do this in order to obtain the same thing. Okay, so following the exact probability theory that you learned in the past, you would be doing 6 divided by 49. Okay, and this is your answer. Just the reverse of this, 1 over this, will also give you this, which is, for which you will just do the opposite and you'll get the same thing. So what we have seen with the help of that example, I know I may have taken 6-7 minutes explaining you that, but that is very important, because if the chances of winning are so slim, we do not include it in the core investment definition. Okay, so that's one. Secondly, when you buy the lottery, you can think it in terms of the worst thing that can happen to someone is similar to that. Okay, and that's something we do not want to include. And thirdly, which is something we promote in our school, I can just quickly tell you what we promote in our school. EFMD, European Foundation of Management Development. Okay, so how can I find the website? EFMD. Yeah, so okay, about us. Now let me quickly tell you what is this. This is an organization that provides recognition to schools worldwide. Okay, and we are one of them. Our business school has been recognized by EFMD, and you will see what they say about their mission vision somewhere here. Can you see? EFMD is a network for schools and companies that aim to develop socially responsible leaders and managers looking for opportunities to connect. So with the same logic, this is also our objective, that we want our student to be able to make decisions that are sustainable. So for this reason as well, we do not want our students to think that lottery is similar to the investment, to other investments. Okay, I know I've spoken a little bit here, but hopefully this is clear to everyone that number one, we emphasize the quantitative aspect in this module, but do not worry even if you do not have a strong quantitative background will be there to help you. Secondly, we've got Bloomberg to do so many things for you, and you'll get the output without your significant involvement in terms of computations. However, the engagement in terms of the computation is important. The more, the merrier, and of course, there will be us to help you. Okay. Now, any questions so far? We haven't done much. It's just the introduction day to the module. So I want to go slowly and make sure that we all are happy. Okay, we've defined definition, we've defined investment, and we've said why high level of speculation and something like casino, lotteries are not within the scope of this module. Okay, that's what we've said so far. Okay, I hope you're all fine. Can anyone give me any hint that you all are listening? Yeah, am I clear? Superb. Okay, thank you, Bogdan. All right, now, having defined the investment aspect, we will now, thank you, Rikas, we will now look into different types of investors. And I really want to make use of this slide. And this is something I have been presenting for many years now, okay? And the main reason is, you know, the guru of investment, many people would agree, is Warren Buffett. So why not talk about him? And then sometimes we may think that investors are those that are into, you know, like pension fund, mutual fund, hedge fund, or some companies that are doing wealth management, asset management. You know, in Newcastle, we've got companies like St. James Investment, Brewin Dolphin, True Potential Investment, and so on. So given that you may have learned or heard about these companies, we may have a preconception that these are the only companies that are into investment. But it's important to be able to distinguish that there can be individual investors like yourself, and there can be corporate or institutional investors. And within corporate investors, you can see this is an interesting one. I will enlarge it so that it can be seen by you. Can you see the name? The name here is MU Finance PLC. Can anyone guess what is this? MU. Do you want to guess what may stand for MU? All right. Thanks, James. Okay. Thank you very much, Harris. That's the answer I was looking for. Manchester United. Okay. I like the way you are you are sending the text there. But this is Manchester United. Maybe you saw here on the top. But thank you. But the thing is, football clubs are also making investments, okay? And this is the case of Manchester United, raising significant money. I mean, the story about whether the fans were happy or not is different, but you know, the reputation of the club made it possible in a way to raise such a significant money. This bond is no more available. They've already paid everything back to the investors, and investors received the return, the coupons, timely. People say that they took the money and took it away. You know, the owners, the Americans, they took the money and in a way, this was in the news somewhere, okay? And they used the money to support one of their businesses that was not doing that great in America. So maybe that was one of the reasons why it was in the news that fans were not particularly happy with the owners, and this is happening every now and then, and you may have heard in the news. There can be some other reasons why fans or people cannot always be happy with the owners, but this particular screenshot that I have taken from Bloomberg is just to tell you that investments can be from an individual investor like yourself or Warren Buffett, and also corporate. And when we think of corporate, we may think, oh, it can be HSBC Bank, or it can be a Brewin Dolphin from Newcastle. But it's not just limited to them. It can be a football club as well. Okay. Now, Warren Buffett, genius, one of the richest people in the world, and he has also published so many books, and that's something. When you get free time, maybe you want to do some Google search and read them. I will just start by saying one of his quotes, which is, "Price is what you pay. Price is what you pay. Value is what you get." Okay, and this value thing is very important. I don't know if you're aware. Let me show you something. Let me show you something. Value. When I said value, I can show you something related to value. Value investing. It's so important these days that I think I had to do a folder about value investing. Where is it? I don't know. Maybe I can find it through a quick Google search. Value investing by, yeah, I can show you something from Columbia Business School. Columbia Business School, value investing online course. Yeah, I think this is the one. Value investing, Columbia Business School. Yeah. So you can see that, very important. Price is what you pay. Value is what you get. Okay. There are so many interesting quotes, and each of them is so inspiring to all of the investment communities, and I'll be talking about them again and again in the days to come. All right, so we are just continuing our discussion related to investment, and we're talking about the types of investors, and we just said individual and institutional. Now, investment here have been made. Okay, so the first picture here is showing you put the money into a bank account. Is that safe? Generally speaking, when you put the money into a bank account, that is regarded as a safe investment. It may not grow in terms of value, but you will find your money when you need it. Okay, but can you see there's someone with the gun threatening the cashier, asking to give him the money that is lying there in the counter or inside the vault. Okay, so it is just to say to you that this can be a safe place people generally regard, but there is also some element of risk here. Okay, and this screenshot here is the share price of Tesco, and again it is just to indicate that the share price here, if you see, is rising, but there are also some troughs here, which means they can also go down. The third one here is the picture of a bond that was issued back in August 1792, long time ago. And this is also to tell you the difference. This is also a bond instrument issued by Manchester United Football Club. Look at the way the transaction takes place nowadays. Okay, everything electronic. And look at this picture of a bond issued long time ago. But if you see and compare the characteristics, you'll find so many similarities there because they are the same type of instruments. Here we're talking about coupon, payment frequency, maturity date, and so on. All of these are also available here. Okay, but you will see next week why the bonds also imposes some risk, and this is property, investment in property. Okay, so property prices also fluctuate a lot, although people may argue that in some place the property price always have been going up and up and up, but there are bubbles and crashes. That's something important to bear in mind. Again, here in this slide, what we've just said is different types of investors, different types of instrument to invest. Okay, so these are all important. Okay, now we just looked into different types of instrument, like a deposit account with a bank, a bond, building, and a share. Now we want to move and see and talk about risk. Okay, again, we're focusing on investors. Here we said individual and institutional. Here we said what kind of instrument can be used. Something on the chat, I think. So let me go and see if someone is asking something there. Hi, James. Do you have anything to ask, please?
Hi, yeah, I had it typed out, but for some reason it disappeared. I was just going to ask, is a house still considered an investment when you're liable, like, to still pay the rest of the fees? So obviously you're still going to mortgage it, and the mortgage rates can change, and you're still liable to pay the rest of it. So is a house still considered an investment before it's paid?
That's, yeah, James. That is an investment. That's correct. And investment in property is a good investment, actually, most of the time. So yes, the answer is yes. But in this module, we do not deal with property investment. We mainly focus on the financial securities market. And in your level, we confine just to stocks, equities. Okay, but good question. Property comes within the scope of proper investment. Okay, is that all right?
Yeah, it's fine. Thank you.
Thank you. Okay, good. Yeah, anything, anyone, please just stop me and ask. It's always good to hear from you, and then I will proceed. Okay, so investors, there can be people who would be not willing to take a lot of risk. Some, however, may be willing to take high risk. So on that basis, we can say there can be three different levels of risk: low, medium, and high. And you can simply see this picture and okay. All right. Sorry, Roman, I'm in a classroom. I'll speak with you. I'm in a classroom, Roman. I'm in a classroom. I'm in a classroom. I'm in a classroom, mate. We'll talk to you later.
Sorry.
No problem. I hope I have not. I'm still with my students. Yes. Am I still with you? Oh, thank you very much. Thank you. Appreciate that. Thank you. I just received a call. Okay, and there's no way to stop that call, and I do not want it to offend the caller by just clicking end call. So I just said to him that I'm in a class, and he was happy with that. He's a very good colleague of mine, and you may see him in the business school. His name is Roman. He's a fantastic guy. Anyway, we were talking about investment, different types of investors, and we also said that property is in fact a good investment, but for various reasons we do not include investment in property in this module. The answer is there is only so much that we can do. Okay, I can tell you that there are some study programs wherein property investment itself is a module. Maybe one day we'll have those as one of our modules, but not now. Now, I just told you 3 different types, and if you were to compare these instruments in terms of low, medium, and high risk takers, then banks would be like low, bond again medium or low, and property generally speaking low, but stocks would fall on the high. But again, you know, you can also see the ratings and so many other factors to be able to distinguish clearly exactly the level of risk. Now, very important that we have the understanding related to investors' preferences. In this model, the way the things are organized, you are the investor. Okay, I've got another module where I teach something similar, but in that module, for a different program, there will be a client, a hypothetical client, on whose behalf the student will be managing the money, which then basically means it is similar to working for a company. In this module, you yourself are the client, you are the investor. Okay, so what is your preference is very important here. Okay, and what type of risk can you absorb is also very important, equally important. Well, what I've said here is I've mentioned the term objective. So what is your investment objective? If I ask you this question, what will be your answer? What is your investment objective? You want to multiply the money, isn't it? So you can say, oh, I want double my investment within a year time. Okay, so that can be one objective, but the objective is not complete when you just speak in terms of return. Okay, because in this module you are a sensible investor, because in this module you emphasize sustainability, long term. Hence the reason why if you just say I want double my money within a year time, that's not going to be your complete objective. And the ratios, the quantitative method that we will be teaching you in the days to come also justifies this purpose, because you will be looking into risk adjusted returns. You will not be looking just into returns, you will be looking into risk adjusted returns. With the same logic, when we ask you what is your investment objective, your answer should be double the money by taking high risk. You know, that risk and return should always be combined within your objective itself. Okay, so that's important, that's very important. Objectives should not be defined solely on return basis. Objectives should be combined with the return. Now, objectives are linked with preferences that are also affected by needs and constraints and tolerance to risk. Okay, now we'll be talking about it, so do not worry too much, and we will look. Now, let us look into the objectives into some detail. Okay, so various people can have different types of objectives related to their risk and return. The first one, as you can see here, is capital preservation. So someone with a capital preservation objective you may think would like to make use of the bank account to keep the money there. So do you think then the capital will be preserved? I'm just asking you this question, okay? Capital preservation, which basically means you do not want your money to grow. If you invested £100,000 1 year ago, then after 1 year, what do you want to find out? Exactly the money that you invested. So after 1 year, if you are given back that £100,000 because you put the money in a current account in a bank, is that capital preservation? That's Bogdan is saying no. Anyone else? Okay, Bogdan, do you want to tell me the reason? Oh, that's good. The reason has already been defined by Erikas and again by Bogdan. Thank you very much. So just by keeping the money idle in a bank account, you are not able to preserve the money unless it pays you some interest to cover that inflation aspect. Okay. So such an investor, if you need to classify among the three here, and if you really need to classify, then the person would be a low risk taker, isn't it? If you want capital to be preserved, then you will not be taking the risk. You will not be investing in stocks. You'll not be investing in bonds. You'll not be investing in property. Let's say, for example, you just kept the money in a bank account and that pays you interest just to cover the inflation. Then that will fulfill your capital preservation objective. But generally speaking, when you invest in financial securities, you do not want to limit just to receive your money back in real terms. When I say real term, that means inflation adjusted. Okay. So, but if there is a client with capital preservation as their objective, then such a person must be a very, very, very low risk taking person. Okay. Low risk tolerant. The second one here is capital appreciation. Okay. Such an individual will not bother too much on income such as dividends, stock splits, or bonus. The person will just be interested in the price increase of the securities. If the share was bought for £100, then the objective there is £100 goes up to 120, 130, 140, and so on. Okay, whether or not the company pays any dividend is irrelevant. Okay, so if you think in terms of capital appreciation and link it back to the investors and risk, then depending upon the type of the investment, you can classify them into medium or high. Okay. And then you've got current income. Generally, this is the objective of those investors who need a regular flow of money, such as those in the retirement age. Okay. So people in the retirement age, if they need regular money because they think the pension itself is not providing them enough money to live, in a way, a luxury life or go into different types of holidays, then they would be investing in stocks that pays regular dividend income. Okay, so here current income is only and only concerned with the returns. Okay, so the returns that is coming in the form of dividends, bonus, or share split, and therefore the number of shares has gone up, and therefore the investor is able to sell some of the extra shares that was received by way of stock split. Okay, so that's current income. Now, when we say total return, this is the type of return most of the people in the world would expect because it includes both capital appreciation and current income, which basically means you want the share price to go up and you also want your dividends to be received. Okay, now these are different types of objectives of different types of investor. When I say different types of investor, I'm linking it to the level of risk. Okay, so if you think in terms of total return, then you can link it with the people who will have, again, depending on the type of the securities that have been invested, medium to high. Okay, so we just quickly explained on different types of investment objectives. Now, in terms of preferences, for here there is just a warm up or wake up wake up kind of question. So maybe you want to read it and give me the answer. The choice A and choice B is here. You can read it. Some of you who need a small break, you can take the break. But I will be continuing the discussion, and I will try to finish a little early without taking any break, if that's okay to everyone. Okay. But if you think, no, we all need a break, then let me know now, and we can take a 5 minutes quick break. No? So I will wait for another 10 seconds to see if you think you really need a break. As it is online, you can always take some break, come back and join. Okay, that way we will be able to finish slightly early. Okay, that's fine. No one is asking me for any break. So this is the question now. The question is, there are two people here, A and B, who you think is a retired person. The investment objectives are written down. Person A, investment objectives. My foreign and domestic exposure should range between 85 to 95% of my total portfolio. Balance fund, I will invest in treasury bills. Person B, my fixed income securities would be about 50 to 60% of my total portfolio. Of these, 5 to 25% I should invest in treasury bills for extra liquidity and safety. The remaining I should invest in high quality stocks. I think there are some answers already there in the chat. B is retirement. B is retirement. That's correct, because as you can see, the person B is investing in bonds, and about 5 to 25% in even liquid investment treasury bills, and it's talking about liquidity and safety. And even this investment in stocks, the person is saying will invest in high quality stocks. Okay, so the answers were obvious. Of course, I just kept it here to have your engagement. You know, when people talk for longer than 25 or 30 minutes, we may have our eyes open, our ears sharp, but our mind may take us somewhere else. So it's important that I have such questions every now and then. Okay, now we need to talk on needs and constraints. Okay. Now, you know, at the start of this discussion, I said to you, what I'm going to say in this lecture is going to be relevant for your assignment question 1. That's true, because, you know, you need to talk about your investment, okay, your policy statement, okay, and the policy statement will be guided by these, your objectives, okay, your risk tolerance level, your needs and constraints. Okay, so these are therefore important agenda which you would be required to incorporate in your writing somehow, okay, depending upon your own individual preference, objectives, need, constraint, risk tolerance. Now, I'll be talking about these, but these are explained by the terminologies as well. So needs and constraints, liquidity needs. Okay, now there could be long-term and short-term needs. Okay, so you may visualize that I would not need money now, and that can be true for you because you are very young. Okay, people who have just graduated and have taken up a job, they may not need money for a fairly long time period compared to another person who has retired, because they would like and love to be spending. Yeah. So for those reasons, liquidity is important. And you can also think of, investors who can lock the money for the next 5 years, but on sixth year, it can be the case that the person is going to marry and therefore would need some money for whatever reason, honeymoon, travel, and so on. So you may have your objective to double your money, but you may need some of those money back in 5 years time because of those needs and constraints. Okay, now time horizon and liquidity are related to each other. Okay, so as I said to you, time horizon 5 years you can invest, which then basically means for 5 years you do not need to remain liquid, but after 5 years you need the money back because you're expecting to be a father or a mother in 5 years time, therefore you need to spend money, and so on. Okay, so liquidity and time are related to each other. Tax concerns, I mean, people in high income tax brackets, they do not like dividends. Okay, because they may have to pay high income, even higher income tax because of the dividends that they may receive. And this is different in different countries. For example, in the US, the tax against dividend can be different than those in European countries. Equally important to think is what is the tax in case of capital gain, and capital gain tax are only required to be paid when you realize those capital, which means only when you sell your financial securities. Otherwise, it would just be considered as unrealized tax liability. Yeah, there can also be various legal requirement, and as a reason you may not be able to invest. For example, in some people may not be able to invest in countries abroad because their government doesn't allow for an investment, and so on. Regulatory factors are similar to legal, and if you see the final one, which is unique needs and preference, this is mainly to say some people may not want to invest in, let's say, sin stocks. Okay, do you know what is a sin stock? Anyone knows what is a sin stock? Idea? Yeah, thank you very much, Jasmine. That's good. Yeah, excellent. You guys are clever. Yeah, that's correct. Cigarette, drugs, tobacco, alcohol. Yeah, and there can be so many other things that we don't want to talk here, but you know what I meant. Okay, so that's very good. Some people, because of various reasons, such as sometimes it could be religious reason, therefore you would not be investing in certain type of companies producing something, and sometimes people may have reasons such as if it is meat producing form, then I will not be investing because I'm myself a vegan, and so on. This can be the individual needs and preferences. So although there can be a scope to earn, let's say, significant money if you were to invest in particular tobacco company, because of your unique needs and preference, that may not happen. So these were in relation to needs and constraints. So far we discussed about investment objectives, preferences, needs, constraints. We also discussed different types of objectives, but at the same time, what I have said and requested to you is do not think of objective just in terms of return. You always need to combine risk and return together. Okay, I just want to see who is available now. Okay, because oh yes, Saba is here already. That's good. Okay, Saba, can you hear us?
Yep, I can hear clearly. I actually have been here for 15 minutes enjoying the lecture. Reminds me of my student days.
Saba, it's always a pleasure to have you. And I have already told my good students here how much materials we have for them and how much you have contributed in this module. And Saba, I think you already have met majority students and have also taught them. But just for the benefit of those who are new, maybe because they have joined as a top-up students, um, do you want to introduce yourself? I've already made some, but I'm sure students will be more than happy to hear you.
Sure. First of all, welcome everyone, and it's exciting to see 41 people at an online lecture. That's an achievement in itself. Welcome to the module, everyone, and I'm pretty sure Benam has already introduced you to the key concept behind the module. But long story short, my name is Sava. I've met some of you during induction. Some of you I've taught before on derivatives. But for those of you who just joined, or for those of you who haven't did an introduction, basically, I am Deputy Program Leader for Finance and Investment Management, and I'm also a seminar tutor at this particular module that's coincidentally is also called Finance and Investment Management. And again, I just wanted to emphasize my office hours and my willingness to help and assist all of you. As you might know, I've been a student on this program and on this very module myself not so long ago in 2016 and 17, and I've actually been a top-up student from Finance University in Moscow. So if there are some of you there, nice big shout out, привет. Also, I just wanted to mention that we've got 2 workshops with you on Thursday from 2 p.m. until 6 p.m. Привет, Bogdan. And some of you might be there with me, and I'm excited to meet you in person there in the Bloomberg room, our fabulous Bloomberg room. And if you've got any queries and you wanted to meet me face to face, then I'll just type in chat and repeat my office hours, which is Monday, Bloomberg room, 12 p.m. until 5 or 6 p.m. So on the safe side, 5 p.m. And then Thursday, it's 11 a.m. until 2 p.m., which is quite handy as it's right before the time when half of the cohort has their seminars. That would be in my office, now my proper office, for a more conventional experience. That would be room 437. So that's my office hours. Don't hesitate to approach me. And I also wanted to just touch upon some frequently asked questions about the module and the assignment, and kind of clear the air a little bit. Binam has already done a wonderful job in clarifying question 1 in investment objectives and investor profile. And what I wanted to add from my side is that you might be quite overwhelmed with the amount of work that you have to do as per the assessment brief. But I want to reassure you that investment management is such a unique module where you can score a mark of 80% while only understanding 20% of the content. You do not have to understand everything that's being taught. You need to have a nice exposure to a wide range of finance theories and apply these that you feel are, first of all, convenient for you, that work for you, and that you feel are true and applicable. Then you might be challenged to kind of understand what's going on there. For example, you have to apply, I don't know, stock valuation, behavioral finance. I haven't covered it in the class. It's not a bug, it's a feature. We will be covering all of these sequentially as weeks progress, and you'll be able to have a full mode of experiential learning. First of all, you'll start investing, whereas only knowing the basics, and then when you learn more and more, when you rebalance, you'll be able to contribute to better, perhaps, asset allocation. Something else is that we do encourage you strongly to start investing from week 3. So in 2 weeks' time, I expect at least some of you to already have started their portfolios. That's not a formal requirement, but it's a strong encouragement. You learn more that way, and you will take more onto your future job experience if you start investing early. So do come down to the Bloomberg room whenever it's free. Do research stocks. Start tackling this assignment. The earlier you start, the better. Usual stuff. Also, you might have already seen the sample assignments, and you might be pressured to replicate what they're doing. Again, a frequently asked question. You don't have to replicate what they've done. Those are there for you to be familiarized with the structure and see how strikingly different takes on investment management can all be equally successful. I won't be telling you which marks every single one of those sample assignments scored, but they are all first-class assignments, 70 plus. You can all do equally well or even better. And finally, what I wanted to say, did it evade me somehow? Oh, yeah, that we've got loads of additional materials. You can learn much more than we've given you in workshops and lectures by looking at additional materials in the Blackboard folder. There are loads of papers that you can use to build your reference list. There are loads of additional video recordings and additional Excel spreadsheets for you to practice. So the sooner you start, the better. And I'm pretty sure that's all I wanted to say. So thanks very much, Vidam. Looking forward for the new cohort. See you, most of you, on Thursday.
Thank you very much, Shava. Wonderful, everything that you said, very relevant. Thank you. Okay, thank you, Bogdan, as well, and thank you everyone for listening to Saba. I think Saba made it very clear to you about the need for engagement. He also mentioned to you about the amount and different materials that we have, including the sample assignments. But I echo with him that compared to what is already there in terms of sample assignment, you can definitely do even better. Of course, we need to take a small pain, a small effort, and we'll be there to help you. Okay, that small pain, small effort, I would relate it to something like no pain, no gain. Okay. When I said no pain, no gain, do you want to tell something similar as a phrase that would be relevant to investment? No pain, no gain. In terms of investment, do you want to think a phrase, something similar but related to investment? Yes, Jacob, that's what I was looking for. No risk, no reward. And this is same everywhere, yes? Okay, fantastic. I mean, I have to tell you the truth. I also teach a module in which I provide examples in showing students that there are some securities where the risk is lower, but the profit, the return is higher as compared to instruments that are risky. So the statement, no high risk, high reward, may not always be 100% correct, but the philosophy taken by this module agrees with this statement: no risk, no return. Okay, so we continue with our remaining slides, and here I have provided you some links related to finding out how risk tolerant person you are. Now, this is also one of the requirements of the assignment task, because your assignment also requires you to have at least 5 different sources which you should have used to find out what type of person you are in terms of risk tolerance. Okay, I've given you 3. We can give you more, but it's important that you are also able to find out some of these risk profiling questionnaire yourself, and that way you'll be able to differentiate your answer from other students' answers. Okay, so in your free time, you can take those tests. Now, once you'll have taken those tests, you would need to give the score, and when you will be using different sources, you will come up with different types of scores. Some companies may be saying, oh, you scored 40, which is high risk observing person. But to be able to use mathematical formulas, we recommend that students are using these numbers to match their risk tolerance label. Okay, so if you think you are someone who is always willing to take high risk, then assign yourself a number 2. If you think you are someone who hate risk taking, then you are very conservative in terms of risk taking, therefore assign number 4. That then basically means the web pages such as these may be giving you a different number, but as long as they give you some indication in relation to what type of person you are, within the range of conservative to aggressive, then you should just assign this score, because later on you will see these scores are going to be helpful also to compute other formulas such as utility score. Okay, now just a few on the importance of involving the right asset. It's very important to find out which is investment structure is suitable, what equity investment styles are important, and so on. And these can be very helpful in your discussion of your asset allocation. And this is something, again, we'll be talking in the days to come, so there's not much to worry now. Now, I just want to give you some summary of the whole process, okay? Sometimes you may encounter the process in the form of a diagram such as this, which is basically telling you how you start. If you were to work for an investment management company, you start by asking the customers their investment objective. As soon as you establish the objective, you will have already also known on the risk side. Therefore, you will be taking those risk tolerance tests, and something like what I discussed, preferences, need, constraints, those will also be established, because by doing all this, you will be able to have a clear policy statement, and with that, you will be able to draw some guidelines, and that will help you to find appropriate investment vehicles such as stocks, bonds, ETF, or whatever are there. And finally, you will be able to monitor the progress. If there are any fluctuations, then you'll be taking corrective actions so that you'll be able to bring it to your original level. And that's something we call sometimes rebalancing, but this is a very ordinary diagram. Now, if you want to think in terms of a full frame diagram, then this is it. And you can also think this particular chart as something, as a synopsis, as one screenshot that describes the entire module. Of course, there's behavioral finance somehow missing here, but in a nutshell, this is what we do in this module. Okay, so you can see that this should make sense, and this is, in a way, the bigger and better picture of the investment process. So the one I showed you before is simple, this is comprehensive, and this is something that you can take as the guide to your entire investment process. Okay, next, there are some further consideration, and we are talking in line with what you would be doing if you were to be working for a wealth management, asset management, or investment banking unit. Of course, you'll be putting the money in different asset classes. Timing is important because you want to buy low, sell high, and therefore timing is important. Frequency of evaluation helps you to take the important corrective actions, including rebalancing as per the policy statements set earlier with the client. But in the end, if you are working for a company, and if it is not an investment you're making for yourself, you always need to think that the investor is the king. Your job is to give all the good guidelines and the advice, but ultimately it is the investor who makes the decision. Okay, therefore we say investor is the king or queen. Okay, now what I'm going to say next is sometimes also called strategy. When we say strategy, we can think it in terms of tactics, plans, actions. But in the investment process, when you are constructing your portfolio, there can be different strategies, but particularly in relation to the asset allocation and construction of the portfolio, you can have two approaches. One is known as top-down approach, another is bottom-up. Now, top-down approach is kind of passive, whereas bottom-up is active. I'm assuming that you are already familiar with the terminology like passive and active investment. But just to be brief and quick, passive is one in which you would not bother about the company at first. You would first identify where you want to invest. You may want to think in terms of continent, Europe, North America, South America, Asia, Asia Pacific, and so on. And then you may want to start thinking in terms of countries inside those continents. And then you may want to think in terms of, the big sectors. And after that, it's like a funnel. You are trimming down. So then you may want to think sub sectors. So if you said financial, then banking, and inside banking, maybe commercial banks. That is the way you're selecting from top to down. And finally, you may impose criteria such as those stocks within the insurance companies coming from North American regions having paid top 10 percentile dividend yield. Okay, so that's basically top-down approach. Another would be bottom-up, wherein you are just saying, I know this company, this is the best company, I've been doing all the technical analysis, I've done so many fundamental analysis, and I know this company is the best. And that's basically some kind of a stock picking that's happening there. That's bottom-up. Okay. Now, I've just mentioned quickly on the passive and active as well, and therefore I have now a question to ask you, which is, market is in its strong form efficiency, i.e. prices reflect all available information. Which strategy is better? Do you want to say something in relation to this question? Market is in its strong form efficiency. So information cannot be hidden. Everyone knows everything. Okay. In such a situation, what strategy is better, passive or active? I know you may like to look into and read more about active and passive management or strategies, but having heard a little bit on active and passive, okay, Rikas, that's a good answer. So B. Sorry, did you say B? Rikas?
Yeah, I did say B.
Market is in strong form efficiency.
Yeah.
So
okay, I can explain my reasoning behind that choice if that's correct.
Of course.
Usually when I think, and I didn't Google active management, but usually when I think about active management, I think about higher returns just because of that active management element. Usually when I think about passive investing, it's more of kind of, investing in an index and just watching your, money grow over time, but slower. So when I'm thinking about the market reflecting all possible information, I know that, well, maybe if I know all the possible information in the market, I might be able to take more risk, therefore maximize my return, and maybe active management is the way to do it. But it's just my thought process, and it's just an idea, and I don't know if it's correct, so please correct me if I'm wrong.
Erikas, you gave some reasoning, and I cannot completely disagree with them. So what I would say is I appreciate your engagement related to this question. So thank you very much for that. But when the market is really efficient, it means everyone knows about the stock. So if you try then to become active, then it is not going to be very helpful. So the answer to this question, therefore, generally speaking, you should be taking a passive strategy, which then basically also mean that you should aim to match your return with the return of the benchmark index. You do not want to beat the benchmark. But we'll be talking about these in the days to come. I just wanted to give a flavor of, efficient market hypothesis here. We will have a different session on efficient market hypothesis where you will learn more on these topics. But here you can think it in or in the other way, which basically means, you know, the coin has two sides. So if you think from the other side of the argument, then what we can say is market is highly inefficient. Very few people are clever. What strategy would you implement then? So then you will say, I will remain active, isn't it? Because not many people know about the timing which is good, the stock which is going to perform better. So maybe if you think by twisting the question, Erikas, maybe the answer then will be easier for you to then say that when market is inefficient, I will have the opportunity to make more money because I know about the stocks. Hence the reason why the answer will be active. And if you're happy with this logic, then when the market is efficient, the answer should be A, passive strategy. But please, please, I really appreciate what you said, okay? And I liked your reasoning as well. But generally speaking, if this is the case, then the answer would be A, passive strategy. All right? Okay.
Yes, thank you.
Thank you very much, and you're welcome. Anyway, again, here is something on investment decision. There are various considerations that needs to be made when it comes to asset allocation, sector allocation. Of course, equity and bond selection decisions is also important. Although, however, I have to say that bond is not an instrument that is allowed in this module. Particularly in your assignment, okay? And finally, what is important in your selection is the forecast that you are going to make about your market. Do you think the market will be going down, or do you think there's a scope for the market to rise up, i.e. bullish? So in that regard, we can answer these questions, and I'll just play it like this. Which basically means when the economy does well, company profits goes up, share price goes up, economy goes bad. Generally speaking, company cannot be doing as good. Therefore, there are chances that share price will go down. You know, these kinds of logic, when you apply, you'll be able to answer questions related to various economic indicators, and therefore you will be able to answer these questions. So if the economic variable inflation increases, share market effect, what will happen? If it decreases, what will happen? I mean, high increase, high decrease are really bad, but then you can think that increase can be sometimes better. But again, it depends on how high, how low. Corporate profits increase is good, decrease is bad. Unemployment increase is bad for your investment, and unemployment decrease is good. Budget surplus is good, deficit is bad, because when there is no budget, the government will not be able to make economic expansion activities, hence the reason why this will also have effect in the business, in the economy. Therefore it will have effect on the share market, and here is the answer. Okay, I mean, you don't need to agree with all of them, but generally speaking, corporate profits, unemployment, budget, inflation increase is bad. A decrease can also be bad. Okay, think about it, but depends on how high or how low. And this is about the currency. Strong is good. If the currency is weak, then it is bad. But you also need to think in terms of which type of investment are we talking. If you think of the export business, then weak pound is good for them. Okay, so the answer for here, you need to play some cautious, because for export business, a weaker pound can be good. Interest rates increasing can be bad. Money supply, moderate growth is good. Rapid growth is bad. And these are the answers here. Okay. Now, the reason why I spoke about these is mainly because, again, in your question number 1 of your assignment task, you would be required to provide your market view judgment. Okay. And finally, what I would like to say here is I have today just provided you an overview of the investment environment. Of course, investment is a very vast field. Most fund managers, of course, underperform their benchmark. Okay, so it is not an easy task, otherwise everyone would be rich, isn't it? And you can also think in terms of how many knowledgeable people within the investment market the economy is producing every single day. So many, because you can just think in terms of how many people are getting CFA qualification, so many more than past years and so on. Okay, but together, I'm not going to say I will help you. Together, through the level of engagement and spirit of engagement that you've shown in my discussion today, we will achieve the best that we can. Okay. So it's 40 past. We didn't take any break. What I would say to you now is I didn't talk about the assignment question. I only said to you that this particular lecture is important, particularly for question number 1. So please, when you get some free time, look into the assignment question. I will, and Saba as well, will be providing you the details. We will provide you a lot of support, as we already said, and Saba already witnessed that. There is this drop-in session where you can meet Saba and sometimes myself to discuss about your question, and we will find a way to help you. Okay. Finally, what I need to say to you all is we teach students how to make investment in the securities market. Okay. This module does not relate with real asset investment. Real assets are those like tangible things like land, building. We look and deal with only financial assets such as stocks. In your assignment, you only need to deal with equities or stocks. But when you are able to apply the models, you will see that similar models can also be applied in the case of other assets. So these learnings will be helpful to you in many aspects. Final word, if some of you also want to apply and take those professional qualifications such as CFA or CIPM, I would encourage that you take those exams after finishing this module, because in this module there are so many things that are going to be similar to what they require in those exams. Okay, so that's all that I wanted to say from my side. So I would like to call my day, but I'll be here to answer any question you may have. So the session for today is finished, but if you have any question, just let me know. And thank you once again for patiently bearing with me for all this 1 hour 45 minutes. Thank you very much. Okay.
Can I ask a quick question, Behnam?
Everyone welcome who are typing in the text and expressing their thanks. I'm thankful to all of you as well. Yes, please.
Yeah, can you hear me well?
Yeah, please. Yes, you're
great.
clear,
So,
Rikas.
Yeah, that's great. So,
am I calling your name clear?
yeah.
Is that the right way, Rikas? Yeah.
Yeah, it's thanks. Yeah, that's perfect spelling. So,
Thank you.
just going back to that active management in efficient markets.
Yes.
So, I was just thinking after your answer. So basically, do we not have a paradox here where if you think that active managers might be able to incorporate the market's information much better, doesn't active management really drive market efficiency when we're kind of pushing it away? So do you know where I'm trying to get at?
Yes. No, I understand. Therefore is the reason why I said to you that I do not completely disagree with your reasoning. There is some value in what you are trying to establish. That's really correct. Hence the reason why I just flipped the coin. I asked you the question, what would be your answer if the question was, the market is inefficient, which strategy would you use, active or passive? Market is inefficient. You will not be taking a passive strategy then, am I right?
No, probably not. No.
Yeah, so just thank you. So just based on the narrative of that question and the choices that were given, the again I would put this word, generally speaking, the correct answer would be passive. Okay, because simply because you cannot beat the entire market. Why we are talking entire market? Because everyone is knowledgeable. So when everyone is knowledgeable, then it's difficult to beat the market. Everyone knowledgeable means market is efficient. Hence the reason why it is better not to spend your time and money finding out which particular stock is superior than which others. But can I tell you, Erikas, nowadays, mostly in the developed world, market is really efficient. This then basically means, why on earth there are so many investment management firms, asset management companies there? So if you think it this way, then your answer makes sense. Despite the fact that the market is already strong in terms of efficiency, there are still so many fund managers working hard day and night to see the scope to beat the market. So that gives the answer which agrees with your reasoning that active investment is important. But if you just think on the narration of that question, flip the question, then the second question with inefficient market as the input from the question will then motivate you to become active when the market is inefficient. Hence the reason why I would say the correct choice would be passive. Yeah.
Yes, absolutely, and it's a very interesting topic and discussion, and I guess we'll be learning more about this throughout the module.
Of course, of course. I mean, can I tell you, this module and what I teach is actually Saba's PhD. Okay, and he has very kindly agreed to provide that drop-in session. Feel free to speak with him, provide your reasoning. He will draw pages from his PhD and will be happy to answer several questions. But I will also be there as and when I will have a question from your side. Okay, but I'm very excited that on the first day on this online environment, you guys are asking such interesting questions. I'm excited, really. I'll be there to see you all, even those days when, even those seminars when Saba will be teaching, because I only have one seminar, okay? But I'll be there to see most of you, all of you, when I can. All right. I think I took note of the attendance, but there are more students now, but that's fine. I think I've taken 38 or so, 30 or so, so that should be fine. Okay, guys, if you don't have anything else, we've spent 1 hour and 50 minutes, so I'll take the break now, okay? And you all have a wonderful evening, and I will see you shortly, soon, very soon, okay? Bye-bye. Erikas, are you all right now?
Yes,
okay.
Have a good evening.
Okay, Erikas. Bye.
Bye.
Bye.